Let's welcome on board Chakri Lokapriya and figure out what he's making of the market right now. Chakri, hi, afternoon. How do you adjust your portfolio to this new world order, the post-tariff regime?
Good afternoon. I guess we'll readjust the portfolio every single day, every time Trump comes up with something new. And so having said that, I think, clearly we'll have to have a domestic facing portfolio in that sense that companies which don't have any exports to the US. And the second is, all the global facing sectors, metals, etc. I think probably will still stay away from. And it's going to be a conservative portfolio because next 3-4 months, until India arrives at a bilateral agreement, it's going to be a volatile ride.
Right. Good afternoon, Chakri. This is also joining in the conversation. I wanted to get your view actually on the auto space, given the fact that the likes of Bharat Forge, or for the matter of fact, Tata Motors under pressure. You have a lot of OEMs also under pressure on back of what is happening on the tariff front. And how should one actually read into all of these sectors? Because they are traditional sectors that you actually tend to invest in. And given the light of how the news flow has been, how should one actually strategize for the future or for the long term now?
Companies like Tata Motors is fairly simple, straightforward. They have a US exposure, and therefore it is kind of weak. But for the companies like Bajaj Auto, other OEMs, or TVS Motors, Hero Moto, they have hardly any exports to the US, and therefore they should not be impacted as much. So there you would have only collateral damage. That is, if the overall economy slows down because there is turmoil, there's a slowdown everywhere, then it would slow down. But there is no direct impact, and I think we would still, given that Bajaj Auto, Hero Motors, etc., have corrected a fair bit in the last 1 year, we can incrementally look at them as the market stabilizes.
Right, so that's the take coming in on the auto space and the likes of Tata Motors. Yes, under pressure in trade today. You have CLSA that's downgraded from high conviction outperform to an outperform rating. They've reduced the target price also coming in for Tata Motors. So that one is under pressure. You have Morgan Stanley that has also gone ahead and downgraded Bharat Forge. So that's one of the reasons why that stock also is under pressure in trade today. But let's talk about Avenue Supermart, because that one is reacting to its Q4 operational performance. And you have a lot of brokerages also that have come out with the view on Avenue Supermart. Let me actually head across to Snehi to exactly understand how are the numbers.
Well, absolutely. D-Mart, or Avenue Supermarts as we know it, is a stock that's slumping in today's trading session on the back of its Q4 update. Prima facie, it's a good update because if you take a look at the standalone revenue from operations, that's pegged at 14,463.4 crores, which is an uptick of 16.7% on a year-on-year basis. The total number of stores at the end of Q4 FY25 stood at 415, indicating that there has been 28 net store additions in Q4 itself, which is the highest quarterly net store addition by the company. So if all of this is looking good, then why is the stock declining? Here are a few reasons. This is on the back of brokerage notes. Morgan Stanley has maintained their underweight call on Avenue Supermart with a target price of 3,260 rupees per share. They believe that the standalone Q4 revenue that was up 16.7% is in line, and the 5-year CAGR is also at 18.5%, which is higher than Q3's 18.2%. On the flip side, here's what's biting away at the stock is the 5-year CAGR is lower than the average of 20% for Q1 to Q4 of FY24. So FY24 historic levels were 20%. This 5-year CAGR is at 18.2%. So that's something that's inching away at the stock. And they've also said that this implies an SSSG for Q4 to be between 8 and 9%. Citi has also maintained sell rating on the stock, target price at 3,350. They've also said that average revenue per store grew only 3.1% on a year-on-year basis. It's usually in the range between 1 and 7% in the previous 4 quarters. So it's towards the lower end at 3.1%, and average revenue per square feet throughput also grew by only 2.8% year on year. So these are the technicals that are biting away at the stock. But overall, on the prima facie basis, Q4 updates on the revenue front and net store addition front seems to be good for D-Mart.
Chakri, how would you stack up, the traditional retailers like an Avenue versus the quick commerce space, the likes of a Zomato or Swiggy, or for that matter, even a Zepto, wherein the cash burn is really high?
Indeed, I think, all the quick commerce companies the discounting has probably slowed down, partly led by, there is a certain amount of potential regulation in holding them, making them hold back on the discounts that they offer. So that it can in turn turn out to be a fairly good thing for the traditional retailers, the brick and mortar retailers, and they, but those companies have now have to deal with a consumer who's just coming off, hopefully, off a slowdown. And the reason I say that is, with more money in their hands post income tax cuts, they could probably benefit a little bit in terms of more spend per store. But companies like DMart, because they're also expanding so very fast, that will eat into their margins in addition to lower margins of the business in itself. So I'd still stay away from the DMarts of the world.
The value retail space in particular looking to you on the charts right now, the likes of Avenue Supermart, or even for the matter of fact, you have V-Mart as well?
Surely that's for me, right?
Yes, for you, Aditya.
So I would agree, DMart to some extent looks approaching a hurdle of 4,200. That happens to be a major resistance for the stock. Till the time it actually crosses and sustains above that, I won't go ahead and stick my neck out and buy DMart. On the flip side, I definitely do like VMart, and I think it's on the verge of a breakout from a downward sloping channel, though it's a little distant away from current levels. It's around 3350 is where the breakout point is. But my sense is it will break out in the coming trading sessions and should hit levels of 3,800 on the upside. As a disclosure, this is one stock which has been recommended to our clients and would be there in the portfolio, VMart, and we are really constructive on the stock as well. Apart from that, if we talk about quick commerce, I think it's time to look at a company like Zomato, because correction was seen in the stock and now it's underwent a decent bit of a consolidation. So at current levels, I think so Zomato offers an excellent risk to reward. On the downside, 200 is a good strong support, just 10, 12 rupees away from current levels. And on the upside, you can easily see levels of 250 to about 270 in the near term if you hold it for at least a quarter or so. So I think Zomato is something which can be looked at from the quick commerce space, and VMart, I think so, is another stock which looks interesting to me.
Right, okay, that's the take coming in on some of those retail plays, including, of course, the platform companies. But on the sidelines of the Startup Mahakumbh, hear it out from Vijay Shekhar Sharma from Paytm as to what he's making as to what the tariff wars could actually mean for the startup universe.
Different target audiences that you might have. Sir, but one burning question regarding, the tariff issue, which continues even today because Donald Trump has said that, there are going to be pharma tariffs. What do you think the tariffs that have been announced yesterday, and how are they going to impact the overall investment climate? Because investment that's coming into startups is essentially risk capital.
Yeah, I mean, first and foremost, the tariff is an indication of that more and more countries should become self-dependent. And the India AI mission, which is working on building a model for India, it must build. I mean, there is no secret about it. You don't want someday some line to be cut or some tariff to be loaded or something to be done. So I'm very proud of that our mission and the purpose of our company, startups, government and regulator is on the right direction, that we are building things which are making us self-reliant. As far as the investments are concerned, there is no doubt about it. Whenever there is a trouble like investment, trouble like the tariffs, you would have expected the riskiest investment, because we are so India has a very interesting overlap in emerging market intersection startups. So first of all, EMs go down, then the startups go down. EM startups, #India startups are the last ones. But there's a bright spot. India has started to see local investments, and India's, I mean, to the credit of Finance Ministry and SEBI, that they've been able to get so many public listing done for Indian startups. The access to the capital will not be so negatively cut, negatively impacted. But at the same time, the single impact that I can see of the tariff on the startup is the funding.
When you say that there's going to be a near-term impact on the startup ecosystem because of what's happening in the United States and, of course, Europe as well, there are going to be ripple effects. Do you think that that's going to have an impact on the IPO ecosystem overall? Because it's been a pretty, robust ecosystem, especially as far as the year.
You said it very well. If you see EM indexes and the new IPO indexes, obviously there are different kind of price points, etc. But it can, like I said, it'll just settle in few weeks, hopefully, and then it comes back.
So you remain an India bull through and through.
Inevitably, and I definitely want to tell you, I do believe, and I'm going to use this statement many a times, that one point of time there used to be American dream stories and the folklores. There is an India dream folklore that has started and is going on right now. Look, let me tell you, I go to see my batchmates in US. They all want to know how can they come back to India. This I want to tell you. Countries look dull, the technology vibrancy look dull. India is vibrant, market, and so much to build.
So when we talk about building and startups, I have to ask you this question, which has raised quite a bit of furor on social media as well, which is divided over the comments of, India versus China ecosystem. Where do you stand on that?
I love that you want us to become like China, and it is many years of whatever investment in China is done. And I do believe that we will overtake even that. I mean, tell me the spaces that we've been, line items, the line by line, we are overtaking any and every country. And the expectation that is of the startups, it's a legit expectation. And many startups are doing it. It may not have got talked so much. We rather believe that there will be many startups showcasing their deep tech, AI, and there are many who are doing semiconductors. So there is a lot expected and there is a lot happening.
And we're just
All right, so that was Vijay Shekhar Sharma talking about Paytm and the new sound box, also talking about tariffs. But let's talk about IT sector, because that one has been under pressure today as well. Continued pressure coming in for the IT space. Earlier in the day, we spoke to CP Gurnani, who is the former MD and CEO of Tech Mahindra, to understand and get some perspective from him on the IT space. What should one look at and how should one gauge the sector? Listen in.
You cannot make a move which hurts the American economy, and this pain will hurt the American economy. We have seen it in the previous tariffs that were imposed on China. Eventually, did not hurt China as much. It hurt American consumer. So my belief is this is a very temporary pain and things will improve. I genuinely believe that the corporates will actually be using Indian IT, a company like Ionos or AI, to actually come out of the pain that the supply chain and retaliatory tariffs will cause them.
Well, that's the word coming in on IT. Chakri, best avoided right now because of all the concerns, not just around AI transition, which were already at play, but now with US discretionary spends as well, perhaps on the shrink.
IT, actually, the sector does not have any tariffs. It's just that the fear is because there will be an eventual slowdown in the US, in Europe, and that translates lower discretionary spend. So if that is true, then probably earnings will get cut by another, 3 to 5%. Against that, there is likely to be a further derating. So clearly, in light of what has happened in the last couple of days, I think one should remain now neutral to at best to underweight IT.
All right, neutral to underweight on IT. Let's take a look at what Torrent Pharma is doing in trade right now, because that one has actually recovered from the day's lowest point. You remember the entire pharma pack has been under pressure in trade today, and there you go. Actually, it's at the day's highest point. That is Torrent Pharma for you. Kunal, how is this one actually looking on the charts? Looks like it's bucking the overall market weakness. But on the charts, do you think it's looking brighter than the rest of the spot?
It's looking better than the rest of the pharma stocks so far. But the stock has been moving on very thin kind of volumes in the last 1 month or so, as compared to the other traditional large cap pharma names. So maybe that could actually be an indication that the trading activity has dropped down, and that has led to the lack of volatility for Torrent Pharma. On the short-term basis, the stock is nearing a breakout of sorts about the 3400 levels. Currently, it's placed at 3290. So, which means potentially there could be a chance that the volumes may make a comeback, and you might probably expect a more of a trending breakout once the stock crosses levels of 3400.
Right, so that's the view coming in on Torrent Pharma. Let's put the spotlight on SBI. You have an upgrade that is coming from UBS today for SBI, where they've hiked it, upgraded to a neutral rating from an erstwhile sell rating. They've raised the target price to about 840 rupees per share from 760 rupees per share. On the other hand, you also have a downgrade that is coming for for I beg your pardon, IndusInd Bank. That's the counter. There's an downgrade coming from UBS on IndusInd Bank. It's downgraded to the sell rating. They've cut the target price. They're seeing the visibility is pretty weak for this particular counter. Chakri, coming to you, if you have to bet on the banking space, given the fact that that is one of the space that everyone is talking about, would it be the private sector banking space or would it be the PSU banking space that you will tilt towards?
I would rather do the PSU banking space for the reason that most of the corporate spend, which is the PSU by the government, capex spend will go towards the PSU banks, and their valuations are also very cheap. They're trading, whether it's SBI trading at about 1x book to Canara Bank, Union Bank trading much below book value. The risk reward is pretty much in their favor. So unless there is a broad-based economic slowdown, which will then hurt all sectors, banking is in general placed because it completely sidesteps the tariff issue war. It's more about the banks in themselves.
Okay, that's the take coming in on the banks right now. But Kunal, what's your own sense? I mean, I know it's early days yet. Today, HDFC Bank, of course, is reacting to its quarterly updates and Bajaj Finance within the financial pool. But do you think the report card has been handed out? It's HDFC Bank and Bajaj Finance. Are they the strongest of the lot within NBFCs and private banks?
No, I think you can add Kotak Bank, you can add ICICI Bank. These are two names which have been doing reasonably well. So I think the list is getting bigger because earlier the two prime candidates, which in terms of relative performance, which did well, was only Kotak Bank and then ICICI Bank. But now you have HDFC Bank, which is not just showing signs of relative strength, but even signs of relative outperformance. You add to the NBFC pocket, the likes of Shriram Finance. That stock has also done reasonably well. Chola Finance has also recovered from its previous lows in the month of January, February. And then you have the other NBFC pocket, the likes of Poonawalla, for example. That's a stock which has done reasonably well. Aditya Birla Capital, etc. So there are a lot many stocks which are actually showing signs of improvement in the entire NBFC pocket. And I think that's what is making the sector a lot more attractive. You're not restricted towards just 2 or 3 names. Which was seen in the month of February and March, where there were only 2-3 stocks which are moving up higher. But now the space is opening up, and you have lot many differentiated names, different market cap stocks within those sectors which are looking attractive. And I think that's generally an indication that the strength would continue. So after such kind of a sudden bout of volatility, there's bound to be maybe a couple of days of impact into these stock prices. But if you ask of recovery, then these are the stocks which recover the first.
Right, that's the take coming on the NBFCs, especially also the banking space. But Kunal, any BTST ideas that you have?
So yeah, I'll go with a couple of sell calls, and the first one which I would suggest would be a sell on Naukri or Info Edge. That's a chart which is looking weak with a short-term target of 6,200. Of course, the stock is on the verge of a multi-month breakdown below this 6,400 levels where it's closing today. Stop loss could be kept at 6,440. And the second would be a sell on MCX. That stock has confirmed a swing breakdown on the short-term charts, failing to cross over above the 200-day moving average. So would look out for targets in the range of 4,900. Stop loss at 5,150.